Hello, I'm Joseph Graff. This video is one part of a 500-part video series where I analyze the 500 largest companies in America. If you'd like to check out my other videos where I conduct stock analysis on other companies, I will include the link in the description. Also, I'd like to say that if you enjoyed today's video, please make sure you hit the like button and subscribe to the channel. Also, hit the notification bell so you'll be notified whenever I post future updates. Lastly, I'd also like to talk about M1 Finance. M1 Finance is running a great promotion right now where if you sign up using my referral link, we both receive $10 that we can use to invest in the stock market. I'll include my referral link below. Thank you all for watching, and here's the video. The Home Depot was founded in 1978 by Bernie Marcus and Arthur Blank. The Home Depot specializes in home improvement products and services. They supply tools, construction products, and services. The Home Depot's operating segments include building materials, decor, and hard lines. In 2018, the company's largest segment was its building materials segment, which earned them nearly $40 billion in revenue. Decor has been growing the quickest for the company, as they had an increase of 7.9% in revenue between 2017 and 2018. Home Depot is currently the 14th largest company in America and is valued at $267 billion. In this next slide, I will be talking about earnings and earnings growth. These two metrics are important because they are the driving force behind a company's valuation and thus the company's stock price. Companies usually report their earnings every quarter. Large, stable companies tend to have positive earnings, while companies with high growth potential may operate at a loss in the hopes that they will become profitable in the future. Understanding a company's earnings and earnings growth goes a long way in being able to accurately value a company. In 2014, Home Depot earned $3.76 per share. In 2015, that jumped up 25.2% to $4.71 per share. In 2016, Home Depot earned $5.46 per share, which was a 15.9% increase. In 2017, they earned $6.45 per share, an 18.1% increase year over year. In 2018, they earned $7.29 per share, which was a 13% growth. And in 2019, they earned $9.73 per share, which was a 33.4% increase from 2018. This data indicates that Home Depot's earnings have grown on average 21% per year since 2014. Now that we've looked at the company's earnings, we will now talk about its price-to-earnings ratio, also known as PE ratio. PE ratio is calculated by dividing a company's price per share by its past year's earnings per share. Generally, companies with low PE ratios are considered value stocks, while companies with higher PE ratios are considered growth stocks. PE ratio is a useful metric for understanding how Wall Street feels about a stock. In general, a stock with a PE ratio under 15 means investors are somewhat pessimistic about a company's future, while a PE ratio above 30 indicates that investors are optimistic about the company's future. As of May 31st of 2020, Home Depot was trading at $248.48 per share. This represents a trailing 12-month price-to-earnings ratio of 24.7. This is slightly higher than the trailing 12-month price-to-earnings ratio of the Standard & Poor's 500, which at the time of this recording was 21.8. In this next slide, I will be talking about the company's price-to-earnings growth ratio, also known as PEG ratio. This ratio is calculated by taking a company's PE ratio and dividing it by the company's growth rate in terms of a percentage. It is generally thought that companies with a PEG equal to or around 1 are fairly valued. Companies with a PEG above 1 may be overvalued, while companies with a PEG ratio below 1 may be undervalued. PEG is a popular metric among many investors because it takes both a company's earnings as well as earnings growth into account. As of May 31st of 2020, Home Depot was trading at $248.48 per share. This represents a trailing 12-month price-to-earnings growth ratio of 1.66. This indicates that Home Depot may be overvalued if this is the sole metric you use to value the company. In this next slide, we will go over the company's dividend yield, dividend growth rate, and dividend payout ratio. Dividends are generally a sign of a healthy, profitable, mature company. It does, however, indicate that the company feels it has limited growth prospects as the company is choosing to pay cash to shareholders rather than reinvesting it into growth opportunities. Dividend growth rate is the rate that a company grows its dividend payments year over year. A high dividend growth rate is usually seen as a positive to investors. Dividend payout ratio is another important metric. It represents the percentage of a company's profits that it pays out as dividends. A payout ratio below 60% usually indicates that the company's dividend is safe and has room to grow in the future. A payout ratio above 100% means the company will almost certainly cut its dividend, as that means that the company is paying out more in dividends than it is earning. As of May 31st of 2020, Home Depot currently offers a dividend yield of 2.41% as they pay $1.50 per share per quarter. Home Depot most recently raised their dividend in March of 2020 when they increased it from $1.36 per share per quarter to the levels that it is at now. Home Depot over the past 5 years has increased their dividend payment by an average of 21% per year. Home Depot's dividend payout ratio is currently 24.7%. In this next slide, we will be going over the company's price-to-book ratio as well as its debt-to-equity ratio. The book value of a company is essentially the value of all of its assets. Book value per share is simply the book value divided by the number of outstanding shares. Furthermore, the company's price-to-book is just its price per share divided by its book value per share. This metric can help you understand if a stock may be undervalued or overvalued. A company's debt-to-equity ratio is calculated by taking the sum of all of its debts or liabilities and dividing it by the total shareholder equity. In general, companies with a lower debt-to-equity ratio are better equipped to withstand an economic downturn. Debt, however, can be used by companies to grow and expand, which is why a high debt-to-equity ratio is not necessarily a bad thing. As of May 2020, Home Depot had a book value per share of $0. This represents a price-to-book ratio of 0. As of May of 2020, Home Depot had a debt-to-equity ratio of negative 10.5. This information indicates that Home Depot has more debt than they do assets. In the next slide, we will look at the company's 3-year, 5-year, and 10-year return. A company's past performance does not predict its future performance. However, it does allow you to see how a company has done in recent years. In general, a steadily increasing stock price indicates a company has been operating successfully. If you had bought Home Depot stock on May 22nd of 2017, held it for 3 years, and reinvested all the dividends you received, you would have seen an average annual return of 18.4%. If you had bought Home Depot stock on May 22nd of 2015, held it for 5 years, and reinvested all the dividends you received, you would have seen an average annual return of 19.4%. And if you had bought Home Depot stock 10 years ago on May 22nd of 2010, held it all 10 years, reinvesting all the dividends you received, you would have seen an average annual return of 25.0%. In this next slide, I give my grades for this stock. I'll include grades for how I feel this stock is as a defensive investment, a growth investment, as well as an overall investment. My defensive grade takes into account how well I think the company would do in an economic downturn. My growth grade for the company takes into account how much I expect the stock to grow in future years. Finally, my overall grade is my personal opinion on the stock and whether I feel it is a buy or a sell. Keep in mind that these are my own opinions, and I am not recommending you purchase this stock or make any investment without doing your own research. As a defensive investment, I gave Home Depot stock a B-. Overall, I think that the sector that they're in, the home improvement sector, will do pretty well even if there is a recession. What does scare me a little bit about Home Depot is that they have more debt than they do assets. As a growth investment, I gave Home Depot an A-. Home Depot has been great about growing their dividend, and as you can see on the earnings slide, Home Depot has grown their earnings year after year for at least the past 5 years. These are good signs and why I decided to give Home Depot an A- as a growth investment. For the value at the current price, I gave Home Depot stock a B. Their price to earnings ratio isn't too terribly high, and I do like them overall as a company, but there's nothing that really excites me about them, and I think they'll do okay in the future, but not great, which is why I gave them a B. As an overall investment, I also gave Home Depot a B. It's kind of the same situation. I'm not thrilled with Home Depot stock, but they have been good about growing their earnings year over year, and they have a pretty good track record of paying their dividend. So I like Home Depot for the most part, and I think it could represent a pretty good long-term investment. That'll wrap up today's video. If you enjoyed the video, please make sure you hit the like button down below and subscribe to the channel. I'll be doing this type of video for every stock in the Standard & Poor's 500, so keep your eye out for future videos. Thanks again for watching, and take care.